Let's talk about the kind of tension that can send oil traders scrambling and ripple all the way from Tehran to Wall Street. Because right now, the world's energy markets are perched on a razor's edge, where bombs, barrels, and political brinkmanship collide. A few weeks ago, West Texas Intermediate crude was changing hands at $63.42 a barrel on May 14th. Not exactly spectacular considering the geopolitical thunderclouds hanging over the Middle East. By late June, after dizzying swings, prices were only slightly higher. And yet, beneath that surface calm, oil markets have been seething with potential energy waiting for a spark. On June 13th, Israel launched a dramatic strike against Iran. That single act catapulted NYMEX crude for August 2025 delivery to a fresh high for the year. By June 16th, prices had touched $75.50 a barrel. Only days later, the United States added fuel to the fire, quite literally, by bombing Iran's nuclear infrastructure on June 21st. Crude then surged to a new peak of $78.40 per barrel. But just as quickly, a ceasefire announced on June 25th pulled prices back down, with futures collapsing back toward the $65 mark. It's a vivid reminder that oil isn't just about molecules, it's about missiles. The Middle East has always been the world's pressure point, and nowhere is that truer than the Strait of Hormuz, a maritime chokehold through which over 20 million barrels of oil flow every single day. To put that in context, that's roughly 1/5 of global oil supply. Block that corridor, and you don't just disrupt shipping lanes. You send Brent crude prices spiraling into the triple digits, leaving energy analysts, central banks, and ordinary consumers bracing for impact. Iran, of course, looms large in this story. It's the 8th largest oil producer in the world, slotting in right behind Brazil and ahead of the United Arab Emirates. Within OPEC+, Iran ranks 4th, pumping out more than 3,300,000 barrels daily. Even amid sanctions, Iran has found markets. Notably, 89% of its crude exports this year went to China, with minor flows to Syria, the United Arab Emirates, and Venezuela. Now let's layer in some fresh data. According to Apollo Global Management, the total petroleum liquids moving through the Strait of Hormuz consistently hover around 20 million barrels per day. Of that, Saudi Arabia, the United Arab Emirates, Iraq, Kuwait, Qatar, and Iran are the big contributors. China and India are the biggest buyers, along with South Korea, Japan, and Europe. So why isn't oil already over $100 a barrel? Part of the answer is geopolitical restraint. The ceasefire may hold, and markets are betting, at least for now, that major players prefer to avoid a full-scale regional conflict. According to ING, the ceasefire brokered by the United States has cooled immediate fears, bringing down Brent prices, which recently stood around $68 per barrel after a 13% plunge over 2 days. The Brent time spread, which had ballooned to $1.77 per barrel in backwardation, has softened to around $1, still high compared to early 2025 levels, but signaling that traders expect fewer near-term disruptions. But the risks are far from over. ING analysts note that while oil flows from the Persian Gulf haven't been significantly disrupted, any future Iranian military move to block the strait could send oil markets rocketing higher. The same sentiment comes through in RBC's research, where strategists emphasize that the geopolitical premium hasn't disappeared. It's merely gone dormant. President Trump's administration may have signaled a softening on maximum pressure sanctions, even hinting that China could keep buying Iranian oil. Yet senior officials also say curbs on Iran remain in place. That's the push and pull shaping oil's recent trading range. Meanwhile, in the broader energy sector, we've seen interesting price dynamics. WTI. August futures rose 44.8% from $54.13 on April 9th to $78.40 on June 23rd. Brent, over the same stretch, climbed 40.2% from $58.05 to $81.40 per barrel. Yet despite this rally, prices have not broken the psychological $100 barrier last touched in July and August 2022. Product spreads are also telling. Gasoline futures for August delivery rose 30.4% from $1.83 per gallon to $2.39. But distillates like heating oil have been the standout performer, jumping 41.7% over that same window. That's a signal that the distillate market, and by extension Brent, could become highly sensitive to renewed Middle East flare-ups, especially if the Strait of Hormuz is threatened. For investors looking for exposure, the United States Brent Oil Fund, known as BNO, saw its share price surge 34.8% from $24.71 to $33.33 over the same period. Yet BNO's structure means it can't capture all the overnight swings in oil futures markets, leaving some volatility on the table for more nimble traders. Let's pivot to natural gas for a moment because the narrative is starkly different there. July NYMEX natural gas fell sharply, settling lower by 13.1 cents or 3.7%, recently hitting a 6-month low. The weekly EIA report showed a 96 billion cubic feet build in storage, outpacing expectations of 88 billion cubic feet and the 5-year average of 79 billion cubic feet. Mild weather forecasts in the eastern United States from late June into early July have suppressed cooling demand, further weakening prices. Even global LNG dynamics are shifting. The Israel-Iran ceasefire reduced fears that Iran would block the Strait of Hormuz and disrupt LNG shipments. As of late June, lower 48 dry gas production in the United States was running at 105.6 billion cubic feet per day, up 2.7% year over year. Simultaneously, LNG net flows to export terminals were estimated at 14.1 billion cubic feet per day, up 4% week on week. Yet even with this bearish tone, the longer-term bullish thesis for natural gas remains intact. RBC analysts highlight persistent themes like rising LNG exports, surging power demand, the AI-driven boom in data centers, and producer break-evens that suggest higher prices down the road. Zooming back out, oil and gas markets right now are wrestling with two powerful forces. On the one hand, fundamentals remain solid. Global oil inventories have built up, with Asian onshore stocks alone rising 120 million barrels year to date, 2.5 times faster than in 2024. Yet on the other hand, geopolitical risk hangs over the market like a sword of Damocles. Whether it's bunker-busting bombs in Iran, Israeli drone strikes, or quiet maneuvers in the Strait of Hormuz, these events can, and likely will, keep volatility alive. So how high could oil go if the Middle East ignites again? Analysts point out that Brent crude hasn't traded over $100 since the summer of 2022, but the Strait of Hormuz handles over 20% of global crude flows. A military blockade or a single missile strike on tankers could push Brent prices into triple digits almost overnight. RBC's modeling even suggests a spike to $130 per barrel could raise global inflation by up to 2.5 percentage points in some quarters, a shock powerful enough to jolt central bank policies worldwide. For now, traders are cautious but not panicked. Oil prices have returned to roughly pre-strike levels, natural gas is languishing under ample supply, and metals like copper and gold are experiencing their own unique cross-currents of supply fears and macroeconomic shifts. But make no mistake, the Middle East remains the world's fuse. And with oil flowing through a narrow channel bordered by geopolitical foes, the question is not whether prices will react, but when.